Have you thought about the different types of loans that are available as a first time homebuyer? Maybe you just have no idea what's available. Today, I want to talk to you about the difference between a conventional loan versus an FHA loan and how that might work for you and your buying power. My name is Amy DeBusk, and I am a certified mortgage planner. What I'm known best for is making mortgage simple and easy to understand for savvy first time homebuyers just like you, so that you can step into home ownership just as planned. Okay, so in general, there's two major types of loans out there. There's lots of other ones, but these are the major ones that most people end up with. So it's conventional loan or it's a FHA loan. And the major differences are FHA is easier to qualify for. If you have a lower credit score and maybe you have some debts and your debt compared to your income is higher, then an FHA loan may be the route to go for you. If you have excellent credit and you have lower debts compared to your income, conventional loan might work for you. But let's do a deep dive in the nitty gritty differences in these types of loans. And before I start, I want to say one thing. If you only qualify for an FHA loan, I personally would rather see you buy a house with an FHA loan and get into the housing market instead of waiting and trying to get to a point where you can qualify for a conventional loan, because the type of loan that you get when you first buy a house can always be changed later on in life after, maybe you have better credit or higher income. But the main thing is that it's not about timing the market, it's about time in the market. So, here we go. The major differences FHA versus conventional. Number one, your credit score. So, a credit score for an FHA borrower, you could go down to as low as 500. Where I see it work best is 580 and above. And the sweet spot is 640 and above, because if you have a 640 credit score with an FHA loan, you can get down payment assistance on on the HFA programs. And there are lots of different FHA down payment assistance programs, one being the FHA Flex program, the other one being an FHA Hoper program. And these are down payment assistance programs where you only need 580 credit score to take advantage of the down payment assistance. On a conventional loan, in order to get down payment assistance with the conventional loan, you need to have a 680 credit score or higher. And there is some grant money that you can get with a conventional loan through Fannie Mae. The HomeReady program gives up to about $5,000. You do have to be below the income limit in your area for that grant money. So there are some programs for conventional, not as many down payment assistance programs for conventional as there are for FHA, and the guidelines are stricter. So the other big thing is that on an FHA loan, your debt to income ratio can be as high as like 56%. So 56% of your debts can be of your income. Okay. So if you round numbers, if you make outrageous money, $10,000 a month, you could have $5,600 in housing expense and lots of debt, right? So 56% of whatever your income is. Now, on the flip side, conventional requires um, 50% or less. It's actually 49.99. It's a hard stop at 49.99. I will say on both of those counts, if you have a high debts compared to your income, you need to have a down payment and compensating factors like reserves and that kind of thing. and higher credit scores. So, conventional loan, more conservative. You're not going to qualify for as big of a purchase price as you would on on an FHA loan. Now, here is one of I think the major differences on a FHA loan versus a conventional loan, and it's how the private mortgage insurance is handled. So, quick recap, what is private mortgage insurance? So, in the event that you're putting less than 20% down, the bank is going to take out insurance policy on you that is going to cover you if or cover them actually if you default on the loan. So if you aren't able to pay the mortgage payment and you end up giving the house back to the bank has an insurance policy on you that you pay for. So that's private mortgage insurance in a nutshell. And FHA has a standard private mortgage insurance fee. So FHA charges a 1.75% upfront fee of the loan amount tacked on to the back of the loan amount and financed. And then they also charge a monthly private mortgage insurance amount. And it's pretty standard. Doesn't matter how good your credit score is or how bad your credit score is. It's the same unless there is a little bit unless you put more money down. There's a little bit of a break if you put a larger down payment down on an FHA loan on that monthly private mortgage insurance. So it's pretty standard with FHA. Okay. With conventional, oh boy, we have lots of options. So, first of all, unconventional, sweet spot. This is where people get hung up on interest rate. FHA is going to have a lower interest rate than conventional. But when you calculate the 1.75 that they're charging you up front, tacking it onto the back of the loan, and compared it to a conventional loan where they don't have that. The conventional loan, it doesn't have an upfront private mortgage insurance premium. A conventional loan is only going to charge you a monthly private mortgage insurance amount, and it is highly driven by your credit score and the down payment. So when we look at risk factors and what is a higher risk, the higher the risk, the more expensive, and so the lower the risk, the lower that the price is going to be. For example, I just had a first time homebuyer who qualified on a conventional loan with 3% down, and his private mortgage insurance on a $600,000 purchase price was only $100 a month. Where if that were an FHA loan, he'd be looking at about $300 a month. Okay. So private mortgage insurance is handled way different on a conventional loan. It's less expensive. There's no upfront. And there's actually three different ways that you can handle the private mortgage insurance on a conventional loan. You can buy it out upfront. So let's say you get hefty seller credit and you have more money to spend. You can spend an upfront fee to not have that monthly private mortgage insurance. You also you can have a higher interest rate. So you can take a higher interest rate and subsidize the private mortgage insurance inside the interest rate. And then you can take it monthly. And then you actually could do a hybrid of that where you pay a little bit of money up front to get a lower amount on the monthly private mortgage insurance. And then this is the big kicker. So, on a conventional loan, let's say you get a really low interest rate and you never want to refinance. On a conventional loan, that private mortgage insurance will eventually go away and be removed. On an FHA loan, not so much. So if you put more than 10% down on an FHA loan, eventually you can get the private mortgage insurance to go away. But if you put less than 10% down on an FHA loan, which most people do, a minimum down payment on an FHA loan is 3.5%. If you put less than 10% down, then that private mortgage insurance, that monthly amount, it is stuck there forever. And the only way to get rid of it is to pay off the loan or refinance out of the out of the loan altogether. So that is the big difference between FHA and conventional. I did touch on down payment. So, down payment, minimum down payment requirement for an FHA loan without down payment assistance is going to be 3.5%. If you are a first time home buyer on a conventional loan, you can put as little as 3% down. If you're not a first time home buyer, then you have to put 5% down. And the definition of a first time home buyer is if you haven't owned a home in over 3 years. Okay. And then big differences between FHA and conventional is how the different types of homes that you can qualify for. So on an FHA loan, they're going to be a lot more strict on the quality of the home and the condition of the home. So there may be homes out there that you're interested in buying that you won't be able to make an offer on because you have an FHA loan. And you'll see it on the listing where it will say does not accept FHA loans or only accepts conventional loans. So on a conventional loan, they're a little more lenient. The appraiser does not require the home to be as in good of condition as on an FHA appraisal. So it can be a light fixer upper as long as there's no health and safety issues on a conventional loan. Whereas an FHA loan, if there's dry rot on the walls on the outside of the house, if there's a missing railing or anything that could be a health and safety issue, even a little bit of a health and safety issue, it has got to be fixed. So you'll know though, because the listings, they're really good about outlining whether or not it accepts an FHA loan or a conventional loan. So those are the major differences between FHA loan and a conventional loan. If you'd like to learn more about a FHA loan or a conventional loan and what is right for you, I encourage you can log on to talkingwithamy.com. That's talkingwithamy.com. Book your free 30-minute discovery call today.